Hello and welcome back to the StoreHero podcast. This week we are joined with another Irishman on the show. We have Seamus O'Connor, founder of eClarity. Seamus, welcome to the show.
Thanks, Thomas. Co-founder, by the way. Don't leave Stu out.
He leaves me out all the time as well. I know the feeling.
Start again, Thomas.
I'll get a DM now from Stu after this. Sorry, Stu.
Go on.
How's everything with yourself, Seamus? All good?
Yeah, good, man. Good. Coming off a busy Q4, but straight into it then and planning in Q1. But yeah, other than that, everything's good, man.
Brilliant. So let's, I suppose, dive into it. In terms of e-commerce finance, it's a murky world. The buzzword at the moment is profitability. Could you take our listeners through how you got into e-commerce or finance, or how that those two worlds collided for yourself?
Yeah, of course. So my whole career, I suppose, was corporate. So I came from a corporate background. So studied law and accounting in college. Went down the accounting route. Didn't really like law too much. Landed in Deloitte. Worked in the corporate and international tax department. So again, everything we did was cross-border. So, I was working with the likes of Amazon were on my portfolio. Did work with like Disney, Toyota, J2, some big brands. We were getting exposure to States, Asia, Middle East, all of Europe. So from when I started out my career, I understood, I suppose, the international tax and finance landscape. So that always came natural to me. Worked there for, I think, 4.5, 5 years, where I became a chartered accountant and a chartered tax advisor. Wanted a new challenge, went to work for Kerry Group, a big, food ingredients company. Again, doing a lot of M&A in the Middle East in my role, doing a lot of group tax, international stuff. Then a role come up with Arista, which for people in Ireland, Cuisine de France, one of the brands they own, again, a big, large food multinational. Again, I was financial controller for some companies around the world in Amsterdam, Malta, the UK, Ireland, different places, as well as doing projects around the world. Like, remember, Malaysia was one, Australia, the US, Canada, etc. That group then ended up selling off its US business, which was about 40% of revenue. So there was redundancies. So again, I took one and kind of left the business. And this was around COVID. Again, COVID, Ireland was pretty much locked down. So just sold everything I had. Remember, I had a BMW, drove to the airport, sold it at the airport and hopped on a one-way flight to Marbella. And then started networking, got to meet a few people in the e-com space. I kind of took it from there.
I suppose with that as well, it's not the typical accountant path, and it makes sense how your career has gone in a broader space than a typical accountant would. Maybe you can touch on how that experience led you to ultimately offer something other than just standard accountancy services. Naturally, people will tend to start there if they're running an e-commerce business because they have legal obligations to file, whatever the case may be. But maybe you can give people a little bit of context around what the difference is maybe between an accountant and a CFO, and what maybe in your role that's different as well.
Yeah, of course. And obviously, and another thing as well, actually, when I was in Arista, Brexit came, and I was actually on a Brexit committee. So, I spent a year to 18 months, navigating that landscape. Like, we were bringing in raw product from the UK to Ireland, manufacturing it, sending it back. So obviously that was massive in the D2C space. Now the UK wasn't part of the EU. How do you navigate that landscape, I suppose? To your question on how are we different to accountants? Like, I don't really like accounting or tax or finance, but what I do love is help people to build better businesses. I love, providing solutions for people. I kind of always use the analogy, like when I was younger, like when I played football, soccer, whatever you want to call it, I was a centre mid, and I always got more enjoyment setting up the striker than scoring myself. So I like being that kind of person that provides value, provides solutions, and helps people grow. And given I 10 years plus experience in international tax and finance, it just naturally paved the way to kind of go into that space. Accountants are absolutely phenomenal at what they do and what they know, but it's all domestic. It's corner shops, it's news agents, it's manufacturing. Most businesses won't expand internationally till they're doing millions. At that stage, they're moving to, a top 20 firm, a top 10 firm. It's just the way it's always been. So we kind of identified a gap there, that these these e-com brands, they're scaling massively. They don't want to be walking into an office, in Harcourt Street or wherever, meeting some person or lady in a suit. And they just don't want to do that. And they also need this experience and this support from an international landscape. They want to chat to people on WhatsApp, they want Slack. They don't want to be corresponding via email. They want people that will listen to them and understand them, and they want people to understand technology. So it kind of was a perfect storm. Like, I don't like the word luck, but it kind of was, I suppose, the stars kind of aligning with my career. COVID, the e-com growth bubble that came out of COVID. And it just kind of was a natural fit. That's kind of went from there.
Really interesting. And one piece I suppose I'd love to understand, because I know tons of accountants, spoken to loads of them in the last 12 months. My own dad is an accountant, but the context and why I think the fractional CFO part of e-commerce is really booming in the last 12 months is, yes, you can give that strategic guidance on top of it, but I suppose what enables you to give that strategic guidance is you can speak two languages. Yes, you can speak the finance language, but there's this whole other language that exists in e-commerce. You have the e-commerce and the marketing landscape. You've acronyms coming out your ears. How did you figure out, or how did you start to learn about that kind of world as a whole? Had you any experience in e-commerce? Was it just from chatting to and networking in Marbella? Like, how did you actually come to understand all the nuances and the intricacies of how that actually mapped towards the finances of running an e-commerce business?
Yeah, well, I never knew what digital marketing really was before I'd even moved to Marbella, but I met a guy called Adam Power who owns Powered Media, a really successful digital marketing agency. We actually started working with Adam, and that was kind of our first real insight into digital marketing. Didn't know what ROAS was back then, CPAs, CACs, all this kind of stuff. And I just kind of really enjoyed it because, again, to me, like the biggest, most leverage that e-com brands have is data, and understand the value and the importance of that. And being able to take that data and use that as leverage for growth, is really appealing to me. Finance can be used as a lever for growth. You just need to know how. We also do work with digital marketing agencies. Like, I sit on some boards in the space. We'll have like a CMO, CEO, and a CFO like myself. So again, you're working directly with, let's say, somebody in-house. Or, we do work, let's say we have lots of mutual clients with digital marketing agencies where, we work hand in hand. So you have ops, strategy, vision on the founder side. You have, marketing on the marketing side, and you have finance on our side. And when everybody's aligned, you can kind of do great things. Like, traditional finance people won't understand, it's not just all about last click attribution, or it's not, just show me the ROI on this or that. Like, you kind of have to look at the broader landscape. And yeah, that's kind of how we started working with digital marketing agencies as well as e-commerce brands. And it's all we do. We don't do anything else. We don't work with any other types of businesses whatsoever, because I do think that's one place that accountants fall down. They try to be everything to everyone. So they're generalists, whereas you'd be better off just being a specialist in one area and become the go-to person on that, because then you'll understand a lot better, well, how do the commercials and the marketing fall into the finance place? Because you can take off your finance hat and put on your commercial hat. One example might be, you might take a more expensive type of lending because it gives you more flexibility in terms of covenants, or you'd understand when you're doing your forecasts and why we're spending more on a certain product, or investing in people. You kind of can see the broader landscape. You understand the commercial side of the business inside out.
Definitely. And ultimately, if you're a traditional accountant or someone has a traditional accountant, the only impact or interaction they have with maybe the paid advertising spend is one consolidated line item or one consolidated Facebook invoice on a monthly basis, not understanding the kind of levers for growth. And one thing that we've found, and I'm sure you're the same, maybe you can speak to this, that potentially lots of people, a lot of brand owners, founders, they're idea driven, they're inspired to start a brand, but they're not necessarily CFOs themselves, or they're not accountants. So, how do you find people think about those kind of unit economics? Not everyone is maybe coming to the table or getting to the starting line with similar information.
Do you mean someone starting out, or somebody that's been in business for a few years?
Even if someone at either stage, really, to be honest, if they, if a brand is potentially coming to you or an agency is coming to you, everyone is not operating at the same level of understanding of the core financial fundamentals, maybe because some people may have been inclined, that's where they started, but others haven't, I suppose.
Yeah, well, I suppose for the last number of years, like everybody has just been obsessed with, revenue growth, building your list, acquisition, ROAS and stuff. But like at the end of the day, like what's the most fundamental business principle is to make profit. And if you are not profit making, that's just going to lead you to problems. Like, your balance sheet is going to be just going to get worse and worse, which is going to lead to lack of funding. Cash flow in itself is never a cash flow problem. It's usually either one, you're loss making, or two, you're just not doing your procurement right, or you've cash tied up in the wrong places. So like you have to be profitable, like unless you go and raise funding. Like if you're not profitable, like yeah, ideally you want to be profitable in your first order 99 times out of 100, but if you're subscription based or you have a different business model, you can eat that up. But I don't like LTV either. Like LTV doesn't pay your bills at the end of the day or payroll. So just you have to be profitable, like at least contribution margin profitable, because if you're not, you're just gonna, the more money you put in, the more money you're losing. Like it's a leaky bucket. So we have a big focus on that. I also think a lot of people in ecom over index marketing and under index operations. So they'll focus so much on trying to drive up ROAS and creative, etc. Whereas they forget, like, well, if I could just decrease my 3PL cost by 1 or 2% of the P&L, it's going to be massive saving. If I renegotiate with my suppliers in terms of costings or credit terms, that's going to make a big difference in terms of profits or cash flow. And that's a lot of the work we're doing right now. We're definitely seeing a shift in 24 where people are definitely focusing on the operational leverage within the business. So yeah, it's a long-winded way of saying try to be as profitable as possible, because the more profitable you are, the lower ROAS you can scale at. It's quite simple maths, and we can't control CPMs, we can't control platforms, we can't control outages. We had an outage the other day for a big brand we work with on Google. Never had an issue. It said the car, everything was green, everything was fine. It just wouldn't spend money, and CAC went up like 20 quid in CPA. It was completely outside of our control. So yeah, over indexing marketing and under indexing the rest of the P&L.
So important. And like yeah, it's $1 saved in OpEx or on your COGS somewhere is going to flow directly to your bottom line, where that's not the same for driving an extra euro or pound or whatever it's going to be in sales. And that's often something I think people don't fully grasp the importance of that. I think Taylor Holiday actually had a really interesting, funny meme up last week of it was a pint and it was full, and it was a very frothy pint. So it was full, but like the pint was only very much half full, and it kind of drawn some parallels to e-commerce. Your $1 in sale or your 1 pint of beer. Okay, it might be full, but it's a vanity metric at the end of the day, and what you're really trying to get out the back end of it is profit. In terms of, I suppose, problems that we've seen, loads of, I suppose, problems that brands have had in the last 12 months when they come to us. Often some of them are not fully understanding your COGS, again, maybe leaning too much into marketing over ops. If you were to pick maybe 2 or 3 common pitfalls you see brands fall into, maybe not fully understanding their own business, or that they maybe should be aware of, is there any 2 or 3 that kind of stick out that might be worth our listeners understanding?
Yeah, the 2 biggest ones to me would be liquidity and supply chain. So liquidity basically means is making sure you have enough cash in the business to keep going. Like no point, pushing as hard as you can and scaling and that top line like to the wire if you're going to run out of cash in 3 months' time. Like that's ridiculous. Like it's like, what's that book by Simon Sinek, like Infinite Game? Like the goal in business isn't to win or lose, it's to stay in the game, because the longer you stay in the game, the longer you're going to iterate, the longer you're going to get better as a founder, the longer the more time you have to build a team. You're just naturally going to get better over time with compounding. So change that mindset or that scarcity mindset of, we have to grow now, we have to push as hard as we can, because if we don't, someone will take us over. That's not going to happen. It's staying in the game. And I think that's the biggest thing we try to do. We try to act as almost like a gatekeeper for brands we work with. We try to keep them in the game essentially by, managing liquidity, because you can be loss making and be liquid and you can be fine, but you can be profit making and have no cash and you're bankrupt. So that's kind of the biggest thing we do. And then the second thing is supply chain. A lot of these founders, like amazing visionaries, fantastic people, but may not have a lot of experience, just like finance on the supply chain side. So like we actually do have agents in China we work with that we, put people in contact with. And for some brands, we've halved their costings by speaking to these people. They get better credit terms. They get into factories. You don't find these factories in Alibaba. Like, these are factories that you only get to speak to them if you've got an in. So supply chain, liquidity, and then if I had to pick a third one, I'd say it would just be understanding how the marketing side of your business integrates with your operations. So, and understanding yourself as a business. Like the one of the businesses we work with that has got the most profitable bottom line, their gross margin sits about 60%. Their product margin sits about 60%. The reason is because as a brand, they're focused on pricing and offers, and they can maintain a really, really high ROAS, so they can take that lower margin. So when you hear people online saying, oh, you have to have an 80% product margin, or you have to have this, you have to have that. No, you don't. You need to look at your own business model, and how does that tie in with your marketing?
It's a really interesting point, because ultimately there's plenty ways to skin the cat, and there's plenty combinations. Even looking at spend versus ROAS, it's not just one particular equation and one particular setting. There's so many different places to sit. Maybe just to jump off of that last point you made there around people, I suppose, not only defining a plan but then actually forecasting. So as a business, how do you typically think about the balance between not getting too tied up in one forecast that will change over time, but having something there as a reference point to use as a gauge moving forward?
So what we always do is we'll run 3 budgets. So budget is static, forecast is moving. So what I mean is we'll sit down try to sit down end of the year, early January, and do a full year budget. We'll do 3 of them. We'll do, okay, what do we think we're going to do? Okay, what's the worst case scenario, right? What if all things go wrong? What's that look like? And then best case, okay, if we push based off our stock forecasting, based off last year's metrics, what's the best outcome? So we'll have 3 budgets, right? They're static. They don't move unless something crazy happens like COVID or, something completely drastic happens. We'll pace then off our mid-tier budget, but then we'll always try to have debt coverage for our worst case scenario, right? So, you might have a line of credit, you might have an overdraft, just levers you can pull if the worst comes to pass. So then that, look, if worst does come to pass, we'll be okay, we'll see our way through. It's almost like a contingency plan. But we also look at insurance and stuff, business continuity insurance for brands. So for example, if something was to happen, you'd be insured for that against loss of profits, just things like that. So we would do 3 budgets, and then, a forecast, then you update monthly based on performance. So we see how we're tracking then. We'll always do bottom up, so you'll start with, okay, what's our target in CPA? What's our current list? What's our target repeat customer rate revenue versus our new customer revenue? And typically I like to get the marketing team to do that, and then we support. I don't think finance should be the team that's driving the revenue targets, because we've no direct correlation between what we do on a day-to-day basis to revenue targets being hit. But we do help, we do have models and stuff we do. And then we just work our way down through the P&L, what's our predicted product costings, what's the media budget that comes from doing the revenue forecast, what's our projected pick and pack fees, our projected shipping fees, what's our projected processing fees. We'll usually use a trailing 12-month average if you're using multiple processors for that. That gets us obviously our gross profit, and then you take away your media spend, it gets us our contribution, and then OPEX is OPEX, and we'll phase in any new hires and then any cost savings are leaning out within the business. And then we kind of sit down and go, well, are we happy with this or not? And if we're not happy with it, we'll amend it. If we are happy with it, we'll say, okay, here's the plan. Let's try hit this. And then you'll attribute, each line in the P&L to somebody within the business that has ownership then of that.
Interesting. I'm sure that's a big unlock, and often the first time a lot of the founders coming to you have had this really joined up way of thinking between themselves, what the marketers are going to work on, and also some kind of budget or forecast, as you've kind of alluded to there as well. I mean, I know for ourselves, we've gone through this with a lot of brands in the last 12 months. There can be budgets and forecasts done when you really dig into why they're there. It's kind of finger in the air stuff. We haven't really put too much thought into why this is going to be there, why we're going to spend this much that month, how that kind of intersects with the operational expenses of the business, and are we actually even forecasting profitable growth for the business? I mean, sometimes you'll forecast a loss for the first couple of months in the confidence that you're acquiring new customers that are going to come back to you at the end of the year. That's fine if you know what you're talking about and you know why you're doing it, but it might be in the best interest of the business's health, but just getting really laser focused on a joined up way of thinking there, I just think can't be understated for for so many e-commerce brands, because it often isn't. It should be the center of piece in which the brand kind of works from for the entire year, but often it's not there at all, or it's done to a very, very poor degree. And you end up building the business based on a very rocky foundation or unsolid foundation to a certain extent.
Yeah, couldn't agree more. And like, I think the main goal of a forecast is just to predict holes and shortages, because that's the biggest thing. It's not even, to be honest, not even about profitability. It's more so, okay, when do we've a 500,000, cash hole here in June, but at least we know that now in January. How do we fix that? Do we go and get more funding? Do we, alter our, procurement? Do we negotiate credit terms? Like, what can we do here? Do we move on to, let's say, payment on credit with Meta to give us an extra 30 days? It's more about predicting what's around the corner and identifying holes and challenges throughout the course of next year, as opposed to anything else. And a forecast will never be met. And that's not what we don't sit there and go, okay, let's try and meet this forecast. Obviously you want to, but it's more, okay, how accurate were we in our forecasting as well? And I think it can be difficult initially to get founders bought into that, but once they do, they actually really enjoy it. That's from my experience. Once you do that and embed that in the business and they can see the value, it's almost like gamifying it. And it's almost like, right, a trick I use is I almost say, come on, show me what you're worth now. Beat our numbers. I can almost make it a game for them. And that works really, really well.
Yeah, it's a completely different perspective than just purely using it as kind of pure ambitious kind of vision board. Maybe people using a forecast like a vision board and just, again, no serious grounding as to when we actually achieve it. It's not necessarily restricting you maybe to a level. If you're not 100% happy with it, as you said, you can kind of flip it around. I would guess then on that basis that level of aggression as to how our people want to kind of push their growth with cash flow and inventory in mind. There's obviously every business is going to be slightly different, but it's probably going to be the appetite of the founder itself. Different people are going to be more aggressive than others. Would it be fair to say?
Oh yeah, definitely. It all comes down to the founder's goals and ambitions. But as a CFO, or somebody that's quite senior in a business, you always have to be straight to. And if you think that someone's pushing too hard, you just kind of have to say, look, I don't get any benefit from having a hard conversation with you. I think we're pushing too hard. This is too risky. Again, it's your business. You're the founder. But that's my view, and it's ultimately up to them. But you have to have those conversations with people too. That's what they're paying you for. What would they rather? What would they rather? You come and tell them that, and you kind of protect their business, or you say nothing, and then they become insolvent in 6 months' time. I know what I would want to hear if I was a founder. So it's important to have that mental capacity or strength to have those difficult conversations with someone. If you want to be providing value at a senior level, you have to have those conversations.
Big time. I'm sure some of those are fun conversations to be in the room for. In terms of, I suppose, quite linked to that one. We speak to a lot of brands who are trying to grow outside of the UK for the first time, maybe from the US trying to grow into Europe. And to your point there, I suppose, how do you balance those conversations with, I suppose, the need for revenue expansion within the business, but then also trying to, and again, it gets really difficult from a forecasting piece, I would imagine, to forecast out, okay, what inventory are we going to need to enter this new market? How do we think about it, budgeting, forecasts? And again, I suppose it comes back to that risk tolerance piece of the founder. How do you think about that from a CFO perspective? Because I'd imagine that the topic of trying to grow internationally into a new market is one that comes up time and time again for you.
Yeah, 100%. I always look at, what's the current pace of growth and if we're growing within our current market, at a good pace, why are you trying to grow horizontally here? It doesn't make any sense. It's essentially like having a second business. That's going to bring a lot of atrophy on the founder and the team. You're doubling the workload. You're doubling the mindset. You're doubling, the advertising, work, especially if you're going to let's say a non-English country. If you're going to Germany, you might think about running localized ads, a localized shop. You're splitting supply chain in some situations. So to me, if you're scaling, and we've had this conversation recently with a good few brands, especially in the UK, you can easily, if you've got a good product, good creative, good margins, good founders, you can get to 10 million revenue in the UK pretty easily. The market, the TAM is there, So my view is like if you're growing well and you're scaling domestically, I'd double down on that. It's also a better narrative if you're looking for an exit, or if you're looking for investment. Go, hey guys, look, we've scaled to 10 million here in the UK in 36 months. Imagine what we could do with you on board when we enter Europe or the US. It's a much better story, and it's a much more attractive option to investors and lenders, and just in general. It also saves a lot of issues in terms, like, Shopify obviously charge more for, let's say, non-native, or let's say non-domestic transactions. Your transaction fees are going to go up. Usually where you set up your business is where you lived your whole life. So you know the market norms. It's much easier. So my view is if you're scaling in your home country, keep at it. Different if you're an Irish brand. Obviously the Irish market is quite small. But if you're an Irish brand, straight to the UK and try scale there. That's my view on it. If you do want to expand internationally, you need to set a budget. You have to accept you're going to be loss making, to start with. You're going to have a low ROAS to begin. You're entering the market. You're a nobody. You're going to have increased shipping costs. You'll be, depending on the size of brand, you're probably going to still fulfill from the UK or Europe. So again, depending on what your AOV is, like, you can avail of reliefs in terms of customs and VAT, depending on what your average order value is. It just brings so much more complexity to do that, but it can be done. It can be done, yeah. But it's important to have someone by your side that understands the landscape. Like we have a team in the US, a US tax and legal team that will set up all US structures for people. We've teams in the UK, Ireland. We understand how cross-border trading works. So it's important to have someone on your side, or you'll get into trouble in terms of local VAT compliance. You might create a tax presence in a country without realizing it, so yeah.
I suppose even to broaden that out, obviously the internationalization, I suppose, is one key component. Is there any particular, I suppose, trends you see with the best performing brands in your own portfolio of work and clients, or even more broadly? Is it, obviously, as we said, there's a couple of different ways to get there between different unit economic setups and different margins, but do you see any common trends among the people who are best performing brands and the brands you particularly love to work with?
Yeah, definitely. A few of them. Own your own market first, big time. The most successful brands we work with all got to high 7, low 8 figures in their own market, okay? And when I say generally UK and Ireland, okay? Own that market. Because then what you've done is you've built up the inventory, the knowledge, the cash flow, the team that you can expand internationally. You're not spreading yourself too thin. Secondly, very, very strong supply chain. You need a very strong supply chain. It's what all big businesses do. And you need to constantly, it's not a set and forget, it's constant. Every time you're going to your supplier asking for something, whether it's a couple of cent off or a couple of cents off the CPUs, whether it's, better credit terms, just keep asking for something. Annoy them, they will do it, okay? Third thing is a USP, like, what makes you stand out from other brands in the space, that's the most profitable brands we work with are the ones that have that USP. They're almost in a niche market, but a niche market that's got a big TAM. Their marketing efficiency is way higher. They do very, very well. Being profitable is definitely one, because if you're a lot of the brands we work with that are profitable don't need funding. So like there is e-commerce brands out there scaling, doing very, very well with zero funding, zero debt sitting in there, can be done. And yeah, just I think that obviously a very, very strong founder, but a strong founder that's open to taking advice from others and listening, but also it takes ultimate responsibility for their business. So it doesn't pass off things. So we'll, speak to different people, we'll get information, we'll get knowledge, but we'll always make the call and we'll own the call as well. I think they're probably the most common traits I've seen from successful brands that we've worked with over the years.
Just on the founder piece, yeah, I think it's like the strong opinions, loosely held kind of piece there, where you want to keep your own opinions on how to run the business and put your own stamp on it, but be willing to take on advice as much as possible, and listen to other opinions, because everyone's got their own domain expertise. In terms of, I suppose you touched on it there, the supply chain piece coming from China. And obviously, I suppose, even around the world, are you seeing much other hubs pop up? I've seen Turkey myself, Vietnam really kind of come to the fore a lot more in the last 12 months. And also, are you seeing much trouble at the moment with the Red Sea crisis, in terms of either stock getting kind of held up, or the COGS line to get those orders shipped from whatever location they're coming to Ireland or the UK, like really inflating over the last couple of weeks? Because that's something we're running into with a lot of clients at the moment.
Yeah, I'm actually seeing more and more production go to the east now, even away from Turkey. I think prices in Turkey have increased year on year over the last number of years. So yeah, we are seeing a lot of manufacturing come from the east. In terms of Vietnam, MOQs in Vietnam are very, very high. So unless you're a really, really big player, I don't really see much coming from Vietnam. China still is the number one in terms of supply chain. You know, still a lot of brands that if you maybe in the food space or depending what space you're in, some is still manufactured locally. You know, like the UK, Ireland. You know, that can also be done. But if you're like apparel or anything like that, it's coming from the east. We see for the most part, like unless you're like a representative, someone, and even they still use the east, but unless you're someone that has that massive brand rep, you know, you're not going to get the margins you need to be able to sustain, you know, production closer to home. Obviously, it's much better because MOQs are lower, lead times are much quicker. You know, you can have more of like a just-in-time supply chain, whereas, you know, China can be up to 5 months. Very, very hard to predict. But what I would say about that, like if you're a founder and that's what you want to do, like the sooner you start, the sooner you're going to learn. You know, you're going to understand how that works. You're going to get better at it. So yeah, in terms of delays in the Red Sea, yeah, we have definitely seen some delays on that, 100%. And we have seen increased costs because, you know, if we know there's delays, we might get 10, 20% of the order shipped via air, which again, obviously is a multiple of shipping costs, but it's just one you kind of have to hit. And it's good to build in a contingency in your forecast, in your P&L for things like that, but it's out of your control. Sometimes you just have to, unexpected things do come up. You just have to kind of roll with it.
I suppose to kind of leave some takeaways for brands and agencies listening. Ultimately, everything we spoke about there's a lot of really valuable principles, but ideally, we want to put some metrics towards those and actually have something measurable that people can get a gauge for success over on a daily or weekly basis. What are, from your perspective, the top couple of maybe 2 or 3, if it can be dwilled down that much, the North Star metrics that you think brands should maybe place a little bit more of a focus on?
Yeah, first thing, product margin. Like you have to start with your product margin. Like, you know, is your product margin sufficient enough to work your way down the P&L? Because that's where most brands get it right or get it wrong. If your product margin isn't at a sufficient place to scale, you're already starting on a losing battle. Okay. We kind of break it down, you know, like we call it either GP1 or GP1. So you got GP1, GP2, GP3, GP4. So you got like revenue minus product is GP1, you know, minus fulfillment is GP2, minus transaction fees is GP3. You know, then you get your, let's say, your gross margin minus your, you know, paid media, you know, GP4, 5, whatever it is left, and you know that's your contribution margin. Then take away your, you know, your people, your brand, your OPEX, and get down to your EBITDA. So there's not really one. We like to look at them all, to be honest with you, because just looking at one metric in itself, it's a good place to start, but you need to understand how it's broken up. We'll always keep an eye on daily contribution margin, not as a percentage, as an absolute number, to make sure we know we're covering enough to at least, you know, break even for the month. It's a good metric. It's also a good idea to break, if you have multiple stores or multiple countries, it's good to break that down, because, you know, one store might be making a contribution margin, you know, positive, the other might be negative. Why are you even operating on that store? Or, you know, you need to isolate that and fix those problems. You can't look at everything together. You have to kind of break it down. We also look at EBITDA, cash flow as well, profit. EBITDA probably over profit a lot of the time, and then cash flow will cover the balance. Revenue is obviously a very, very important one. Both, you know, Shopify revenue, so including VAT for cash flow plus net revenue, making sure that we're pacing the forecast, because if revenue dips, like that's going to have a massive bearing on your cash flow. Yeah, that's kind of what we look at. I wouldn't say we look at any one thing. I like to look at every part of your P&L on a continuous basis and constantly strive to make it better.
I think in the last kind of couple of years, I suppose the agency game is changing a bit, and people are starting to move more towards, like, definitely not marketers becoming CPAs or accountants by any extent, but marketers, paid media buyers are having to understand the margin structure, the cost structure of the business in order to really become proper kind of budget allocators for the brands that they're representing. Is that a shift that you're seeing yourself with a lot of agencies, in that the they're becoming more finance driven because they ultimately need to be. I think as the skill in really understanding how to really target Facebook ads, particularly Facebook, has that skill has now gone to a more broad level. The real skill, I think, from an agency perspective, is now going to be able to help the brands that they're working with really allocate that budget correctly and profitably. And that's something that they maybe haven't needed to really take into account up until maybe the last 18 months, 2 years.
Yeah, big time. It is a great shift to see, but I always say this like with a word of caution. There's two problems there: data integrity. So when you have, let's say, a marketing team and a founder looking at this together, without a finance person involved, for example, how do you know the data that's being used is right? And if you're basing numbers off wrong data, you might as well not do the exercise at all, because it's going to be the wrong outcome. So data integrity, data input is one of the biggest issues we see with that. And then the second thing is, you should really have a finance person look at that too, because there's things that you might think about, like that'll all be profitability, but what about cash flow? Sometimes, this is all great, like, we're scaling profitably, but we have a VAT bill next month. We can't afford that budget, that marketing budget, because there might be different reasons why. But it's definitely a positive trend. We are definitely seeing that. And the agencies that understand that are definitely outperforming the ones that don't understand that. That's definitely a fact. But I suppose it's probably a bias, but because of the agencies that we work with also work with our e-com clients, we kind of look after that piece anyway. But I'm definitely finding out I can speak to like marketers using finance terminology and from a finance perspective a lot better now than I could have, let's say, a few years ago. Definitely, it's definitely a positive shift for sure.
Nice, yeah. As you said, I think over time people are kind of forced, due to those kind of macro kind of components and conditions, that you want to get closer to the source. And if revenue is vanity, profit is sanity, cash is king, we're all moving in that direction to get to that cash flow component as the kind of daily number, that ultimately, if anything, as you said, it's all kind of moving towards. I suppose for anyone listening who's interested in maybe talking to you, maybe they're a brand or agency, how can they get in touch?
Yeah, you can just check out our website. That's www.e-clarity.co.uk. You can find us on Twitter, LinkedIn, Instagram as well. But yeah, you can find out more information about us and the team on there.
Sounds good. Well, really appreciate the time. I know you're a busy man, and really valuable insights, I think, for a lot of brands who ultimately need that, maybe a bit of a steer or an overarching sense of finance. I think one thing we often say is e-commerce is often perceived as a marketing game, but in the background there's financial fundamentals there that you can't ignore. So yeah, thanks a lot for the time, and we'll be chatting again soon.
I appreciate it, and keep doing what you're doing. Obviously some clients using your platform, and it's made a massive benefits. So anyone listening that's thinking about it should definitely sign up.
Thanks, Seamus. Cheers.
Thanks, guys. Bye-bye.